We will cover the fundamentals of cost accounting, Chapter 5 on cost estimation. So why do managers estimate costs? So basically, again, they want to plan for the future and make good decisions. So then the key question is what adds value to the firm? And again, we're thinking more in the future to make good decisions. So we want to understand our different types of costs, and we've already had these terms. We have fixed costs and we have variable costs. Fixed costs do not change in relationship to our activity. So as sales go up, fixed costs do not go up. But our per unit fixed cost would change. So if we're taking the fixed cost and we're dividing it by how many units we produce, if sales go down, that would go up per unit. If sales go up, it'd go down per unit. Variable costs are the same amount per unit, no matter how much we sell, but in total, the more we sell, the higher the variable costs are. Because again, it relates to the per unit sold. They change along with sales. So the per unit does not change, but the total would increase or decrease right along with our sales. Engineering estimates. So we'll talk about 3 different types of analysis, but so engineering estimates are going to look at what we're producing and kind of identify what is involved in that particular task, and then how we can, better management. So the advantages of that is that we're going to look at each step of the operation, kind of step by step, and then compare it to other operations. And then again, if we had brand new activities, those would be estimated obviously in a different way because we wouldn't have that prior activity data, but a lot of times we do and we're able to. So our disadvantages is that it can be expensive and it's really based on optimal conditions. So our account analysis is when we look at our total cost associated with each activity or each product. So again, we say we've got that fixed cost, and then we have variable costs that increase directly with our sales. So here we've got, if we're going to use this cost estimation, and we've got 720 labor hours, we've got variable costs listed out and then fixed costs. And then we can add those up in total. So then we can make some estimates based on this account analysis that we could have a variable rate per direct labor hour, and then we know how much fixed costs we have at that level. So then here is what that is. So our fixed costs, again, let's circle back there real quick. Our fixed costs are the $21,747. So those are just included there. We don't do any mathematical computations to those. Then our variable cost per unit, we would come up with a rate. So we may go back and look at what that variable cost was, the 22,032, and then compare that to the direct labor hours we used to get a rate. So then that rate is that $30.60. So then you can see again that totals out to the total. So then we can use that estimate at the 720 repair hours to estimate what it would be at 960. So the fixed costs don't change, but those variable costs increase at that amount, the $30.60 per repair hour, to go up. So then we can analyze and predict what we expect the cost to be at any production level. So the advantage of it is that we're familiar with the company. We feel confident that we know kind of how costs react to our changes in that activity. The disadvantages is that they could be biased, again, because you're using your internal data to make these decisions. And then it can have major economic consequences if we make decisions based on those and its biased data. Statistical cost estimation is where we're analyzing costs within that relevant range, and then we're going to come up with some upper and lower levels. So again, it depends on which type of method we use. We'll use like a high-low, we'll use like a regression analysis. So depends on what we're looking at. But if we're looking at a historical of the past 15 months and we have our overhead costs, our direct labor hours, those aren't dollars, but those are hours, and then our material costs, we can input that data into Excel. That's the easiest way to do it, and then create a scatter graph. So the scatter graph shows you, okay, at these direct labor hours, these are what the costs would be. And then you can, if you're in Excel, you can add a regression line and it'll add the regression line right to your scatter graph and give you the formula. So then now if you didn't have that though, you could still use the scatter graph to kind of estimate what that line is, like kind of right in the middle. And then if you carried that down, so they call that like eyeball judgment, you could kind of guesstimate where that is. So then your fixed costs are going to be there. And then the slope of the line as it's increasing is going to be your variable cost, how much it increases with each labor hour, because we can see as our labor hours go up, our total costs go up, or our overhead costs go up. So like I said, there's a couple different methods. So high-low method is one. So what you do is you take your high and your low, calculate the change, and that's going to give you the estimate of what it is per hour. So again, the cost at the high level minus the cost at the low level, and then the high activity, like the direct labor hours or whatever it is, minus that low activity. And then you'll calculate out what your fixed costs are based on your variable cost times your highest activity level, or your lowest level, your variable cost times your lowest activity level, and then subtract that from that cost at that highest level or that lowest level. So here's some numbers. So if we have, this is our high point and our low point, our high labor hours and our low labor hours, we estimate that the variable component is $27.13 per labor hour. So then if we put that into the high formula, so 2713 times the 1,136 hours, that gives us $30,820 if I round it. So then we subtract that from the total costs, and then the difference, the $24,761, is our fixed costs. And then we do the same thing there at the low level. Again, just a very minor difference due to rounding. So that confirms that that is our fixed cost. So then our formula is going to be the 24,760 plus $27.13 per labor hour. So that would be our formula. And then we could estimate it at any repair hours. Then we could say, okay, well, what if we have 960? So we slide that 960 into the X. So the V, it represents our variable cost per unit. Our F is that fixed cost. So that 960 is what we could switch around to see what we estimate the total cost to be for planning purposes. Regression analysis, honestly, it's really easy to do in Excel if you do those scatter graphs and just add the regression formula. But you can also, in like add-on tools or additional tools, you can run a regression analysis where, again, it's looking at all those data points, so all 15 months, and then it's going to spit out what that formula is. So then they kind of describe it again, but it's the same formula we just saw with the high-low. So our X is our quantity of activity. Our activity in this case is direct labor hours. The Y is the dependent variable, and then the V, let's go to the next one. Let me go to the next one real quick. The V is going to be our variable cost, right? So I feel like they're just kind of describing these. Okay, so that's that same formula, though. I guess it's just worded a little bit differently. But the Y is going to be, let me go back. Oops. So the Y is going to be our total costs. So the Y is the total costs. The X is the quantity, or in this case, the number of direct labor hours. The A represents our fixed costs, and the B represents the variable cost per unit. Now, they're going to call it, when we get into the regression analysis, they're going to call it the slope. Because think back to that graph where we plotted in the line. Like I said, as the direct labor hours go up, the total cost goes up. So that slope is how much of our variable costs there are. So again, though, you can see the formula is very similar to what we just did in the high-low, but a little more detail. So then the $20,378 are our fixed costs. $34.63 are our variable costs per direct labor hour. And then we plug in the 960 to get to what we estimate our total to be. And then when you run the regression, it'll also give you a coefficient, a correlation coefficient, and then the coefficient of determination squared. So these indicate the accuracy. So the closer to 1, the more accurate it is. So say it had a 0.96, it's like 96% accurate. If it had a 0.12, it's only 12% accurate. So they're not going to be, legit, like if it's that low. So 0.856 means that the linear relationship does exist between those labor hours and the overhead. And then that coefficient of determination means that there's a 73.3% chance that any changes in our overhead costs will be able to be explained by the changes in the direct labor. So sometimes you'll have multiple choice questions that show you that and kind of ask you those things. So I guess it's good to understand that that correlation coefficient measures the relationship between the two. And then the coefficient of determination gives you the percentage of how likely it is that it would be the cause of it. So what can be some issues is there can be outliers, way high, way low. You could have ones that are all over where they're not linear at all, but then your regression will still form a line. But really it's really not in that type of a setup, if you will. Then there's a learning phenomenon to say that the more skilled our workers are, or the longer we've been making this product or doing this, the better we get at it. So if we're just starting in a new product, maybe the first year or whatever, there's going to be a learning curve, and we're not going to do as good, and then we'll get better as we go along. And that's kind of the nature of business. So we want to determine how do we make that selection on which one we're going to use. So as we're looking at our advantages and disadvantages, if we're just looking at our historical data, obviously if we're in business, we have that. So that's not expensive. It's probably just something we, program the computer, say, hey, give me the past 15 months of data. And it's easy to do it. And then Excel really allows you to kind of look at that data and analyze that data very quickly. So the disadvantage, though, is that it really might not be as accurate as like possible when we're looking at it on a go-forward basis. So we have to be alert to things that will change those cost activities, and then not, again, just rely on the historical data only to make future decisions. Now here again, it shows you the different methods. Oh, and we didn't really talk about multiple regression. I'm not going to have you do that in your homework, but multiple regression just means that there's two different things that cause that total cost line to increase. So maybe there's a labor component and then there's a materials component, or maybe there's a labor component and a machine hour component. So there's multiple things. We'll just stick to the simple regression when doing your homework and your on your test and things like that. But just know that multiple regression exists. So if we just focus on those top three, though, this is saying that these are basically giving us that formula. So in order to calculate our total cost, it's our fixed cost plus these variable costs per labor hour. And then you can see they're not hugely different. But if we're using the account analysis, we came up with this number. The high-low, which again is just the high point and the low point, we came up with that. And then the regression, where we look at all of the data, we came up with this number. So, you know, this, in my opinion, probably that simple regression is the most accurate, because the high-low, like we said, you can have outliers, and that could kind of throw those numbers off. Okay, so that is our cost estimation and analysis chapter.